Yesterday into today, silver didn't just dip, it dropped through the floor. In roughly a day, prices were reported above $120 an ounce and then printed in the mid-70s. An air pocket move that felt less like trading and more like a vacuum cleaner turning on. Screens froze. Spreads widened. People who were calm at breakfast were texting in all caps by lunch. Before we go further, I want to name what you're feeling, because it's normal. When a chart drops like that, your nervous system treats it like danger in the room. Your brain starts bargaining, if I buy right now, I'll get my money back. Or it starts panicking, if I don't sell right now, I'll lose everything. Both impulses are expensive. The whole point of this video is to slow the moment down and put it back in a container. Mechanics, then decisions. So the question for this video is simple, and it matters. Is this a 1980 Hunt Brothers style trap, where the market lets you in, then changes the rules and drains you out? Or is this the kind of forced liquidation event that creates a once-in-a-cycle buying window? Let's do this like adults. No drama, no tribal talk, no slogans, just mechanics, history, and a practical decision framework you can actually use. Silver price, collapse, 1980, trap, or buying opportunity. What just happened in human language? When a market falls 30% plus in a short window, your brain wants one villain and one switch. But crashes usually happen when three things stack at the same time. 1. A crowded trade. 2. A leverage reset. 3. A liquidity vacuum. Early January was a rocket. Silver ran hard and fast, and that speed created a fragile structure. Too many positions built on borrowed time and borrowed money. Then, the moment price hesitated, risk controls kicked in. At exchanges, at brokers, inside funds, inside algorithms. And once liquidation becomes the dominant order type, price doesn't discover, it cascades. That's why you saw a vertical candle down. Not because everyone suddenly hated silver, because too many participants had to sell right now. What? Liquidity wipeout actually means people hear liquidity and think it's some abstract Wall Street word. It isn't. Liquidity is simply the ability to transact close to the last traded price in size without moving the market. In a healthy market, you can sell and the price ticks down a little. In a thin market, you sell and the price falls into a gap because there aren't real bids waiting. A wipeout happens when buyers step back, sellers get forced, and the bridge between them disappears. That's why you see those shocking prints. It's not always new information. Sometimes it's a broken bridge. And in metals, the bridge can break faster because futures are leveraged by design. The 1980 shadow, why Silver Thursday still haunts this metal. To understand the fear, you have to feel the 1980 story. Back then, a concentrated group of buyers accumulated enormous exposure. Silver surged from single digits toward the kind of price that makes people say, this time it's different. Then the structure snapped. Exchanges and brokers raised the cost of holding positions. Margin requirements climbed. Trading restrictions tightened. Liquidity thinned. Forced sellers appeared. And once forced sellers show up, they don't negotiate. They hit bids until the pain stops. The end result is the part people remember. A brutal collapse that erased months of gains in days, and then kept grinding lower as confidence died. That is the nightmare template, a market that feels like a stairway up and an elevator down. So, does this week rhyme with 1980? Yes, in one critical way. Leverage plus rule changes can turn a bull market into a liquidation event, but the differences matter more than the similarities. Why 2026 is not 1980, even if the candle looks the same. The 1980 episode was dominated by concentrated speculative positioning. In 2026, silver sits at a weird intersection. It's a monetary metal in the minds of many investors, and also a hard industrial input in the real economy. That double identity changes the floor under the story. In plain terms, in 1980, a lot of demand was financial. In 2026, demand is both financial and industrial, and the industrial side doesn't care about headlines. It cares about supply chains, fabrication, and delivery timing. That doesn't mean price can't collapse. It just means cheap can become real faster, because manufacturers and physical buyers respond when the paper market offers them metal at a discount, if the discount is actually available. And that leads us to the heart of the debate: paper price versus physical tightness. The three forces behind the liquidity wipeout. Force 1, the performance bond squeeze, margin pressure. During fast moves, exchanges and brokers often increase performance bond requirements, basically the cash you must post to keep a futures position open. Reports around this move described large increases. When that happens, leveraged longs are forced into a decision they don't want: add cash immediately or sell immediately. Most people can't wire fresh cash at the speed of a falling market, so they sell. That selling pushes price down, which triggers more risk limits, which triggers more selling. That is the loop. How a margin increase turns into a domino line. Here's the cleanest way to picture it. Imagine your long one futures contract. You posted a performance bond, cash that acts like a safety deposit. When price moves against you, your account gets debited. If the loss gets too large, you get a margin call. Add cash or reduce the position. Now layer in a requirement increase. If the required cash to hold the same position jumps, you can get called even if price hasn't moved much. And when price is already falling, the two effects stack. You're losing from the move. You're losing from the new requirement. That's how a normal pullback becomes a stampede. And here's the cruel part. In a fast crash, the call arrives at the worst time, when liquidity is thinnest. So traders sell into the hole, not because they want to, but because the clock runs out. This is also why smart money can look stupid in a panic. Discipline doesn't matter if the position size is wrong. Force 2. Systematic selling, index rebalancing, and risk controls. Big funds don't believe, they rebalance. When an asset becomes too large a weight inside a commodity basket, rules force trimming. Add to that volatility targeting, strategies that must reduce exposure when volatility spikes. And suddenly you have a machine that sells more as the market becomes more violent. It's not personal, it's policy, it's math. Force 3. The liquidity vacuum, the no-bid moment. In calm markets, market makers provide bids and asks. In violent markets, they protect themselves. Quotes widen, size disappears. The gap between last trade and next real bid becomes a canyon. That's when you get prints that feel impossible. Not because the metal changed, because the order book changed. So, trap or opportunity? Here's the clean test. If you remember one thing from this video, make it this. A crash is a trap when it breaks belief and breaks availability. A crash is an opportunity when it breaks belief, but availability stays tight. Let's translate. If the paper price collapses and physical premiums collapse and supply flows smoothly, then the market is telling you the squeeze was mostly narrative. But if the paper price collapses while physical premiums stay elevated, delivery times stretch, and buyers in key hubs keep paying up, then the crash may be a leveraged flush, not a demand collapse. In other words, watch the real-world spread between paper and touchable. Paper price versus physical reality, the divorce test. Silver has two worlds. World A is paper, futures, options, and derivatives that settle financially unless you insist on delivery. Paper moves at the speed of algorithms. World B is physical. Bars, rounds, industrial feedstock, and fabricated products that move through refineries, vaults, and trucks. In quiet times, these worlds track each other closely. In stress, they can separate. You'll hear it described as premiums. That's the extra amount buyers pay over the quoted spot price to get actual metal in hand, now in a specific form. So if spot collapses but premiums stay elevated, the signal is the quoted price fell faster than the real supply chain can respond. In recent coverage of this move, multiple reports pointed out that while futures cratered, physical tightness indicators in key hubs didn't collapse the same way. That's exactly the kind of divergence you watch for when deciding whether a crash is a trap or a setup. The case for this is a buying window. Here's the bullish argument, stated carefully. 1. Forced selling is temporary. Liquidation events end when the weak hands are gone, not when the story changes. 2. Industrial demand is sticky. Solar, electronics, and high-performance manufacturing don't stop because a chart got ugly. They slow sometimes, but they don't vanish overnight. 3. Price can overshoot below fair value. In panic, markets routinely trade below what the marginal physical buyer is willing to pay, especially when the selling is dominated by leverage. 4. A lower price can trigger real demand. If you give the world silver in the 70s, some buyers will show up. Not because they're brave, but because their budgets suddenly work again. If that's the setup, then the collapse is less end of the bull and more reset of positioning, where a floor could live without pretending we know the future. People love asking, what's the bottom? Markets don't hand you a label, but they do leave clues. In metals, a practical floor often forms where three groups begin to care at the same time. Industrial users who hedge input costs, physical buyers who respond to premiums and availability, and producers chalk to scrap flows that react when price falls below replacement economics. Some analysts have pointed to a mean reversion zone in the mid-60s to low 70s as an area where demand tends to reappear, not because it's magic, but because budgets, hedges, and substitution math start to make sense there. That doesn't mean price can't stab below it in panic. It means if silver starts holding that area while premiums remain firm, the odds increase that the market is building a base instead of preparing the next flush. The case for this is the trap. Now the bearish argument also stated carefully. 1. Psychological damage is real. Breaking big round levels can change behavior. People who were chasing at $120 become allergic at $90. 2. Volatility can stay high longer than you expect. High volatility means higher margin, wider spreads, and lower risk appetite. That can keep price under pressure even after the initial flush. 3. A crowded narrative can unwind for months. If too many people piled in late, the unwind doesn't finish in a day. It becomes a grind. Bounce, fail, bounce, fail. 4. The downside overshoot can be brutal. In commodities, overshoots don't stop at reasonable, they stop at capitulation. So yes, trying to catch the exact bottom can turn into a falling knife experience. 3 common aftershock paths, so you don't get faked out. After a liquidation crash, price usually chooses one of 3 roads. Road 1, the V, a violent bounce as shorts take profits and forced sellers disappear. It feels like relief. Then it either consolidates or resumes the trend. Road 2, the U, a messy basing process. The market chops for weeks, confidence rebuilds slowly. This is where patience pays and overtrading dies. Road 3, the dead cat staircase. Sharp bounce, then lower highs, then another flush. This is the trap pattern. It turns dip buyers into future sellers. Your job isn't to predict the road. Your job is to avoid decisions that only work in one road. That's why process matters more than calling the bottom. A decision framework for viewers. No hero moves. Here's a simple, non-dramatic checklist. Use it over the next 7-14 days. Signal A, do physical premiums stay firm even while paper is weak? If yes, that supports the flush thesis. Signal B, do delivery times and dealer inventory normalize or get worse? Normalization suggests the squeeze was mostly speculative. Tightness suggests real demand. Signal C, do margin requirements stabilize? When margin stops rising, forced selling pressure tends to fade. Signal D, does open interest drop sharply? A big drop can mean leverage is being wrung out, painful but cleansing. Signal E, do we see a base form on the chart? Lower volatility, higher volume on up days? That's the market saying sellers are exhausting. None of these are perfect alone. Together, they tell you what regime you're in. The fastest way to turn a good thesis into a bad outcome is emotional sizing. Don't make it back. Don't double down because you're angry. Don't mistake a bounce for safety. In a volatility regime, survival is a strategy. What I'd do if I were you. Educational, not advice. First, separate 2 different games. Game 1, trading paper volatility. Game 2, building a long-term position. If you're playing Game 1 with leverage, this week is a reminder. You're renting exposure, and rent goes up when the building catches fire. If you're playing Game 2, the only edge you have is patience and sizing. So a safer approach looks like this. No leverage. Smaller bites. Pre-planned levels. Time on your side. One practical method is the 3-tranche rule. Tranche 1. A starter position to stop FOMO. Tranche 2. Only if price proves stability. Tranche 3. Only if the physical market confirms tightness. That way you're not trying to be a hero. You're trying to be consistent. The real question isn't, will silver go back to $120? The real question is, what kind of participant are you? Because this metal will always do this. It will seduce late buyers on the way up and punish rushed buyers on the way down. If you want to turn chaos into opportunity, you don't need a prediction. You need a process. If you found this breakdown useful, subscribe, because we're going to track the aftermath step by step. Premiums, positioning, and whether this wipeout becomes a base or a warning. And I want you to comment one word. Trap, if you think this is the start of a long unwind. Dip, if you think this was forced selling and the real story survives.